Great, thanks a lot, Mariam. It's very nice of you guys to invite us to present this paper. So thanks to Mariam, Valentin, Eric, Mike, and Lars for organizing and setting this up. They do make it look like it's easy to organize all this stuff. So thanks a lot. This is a joint work with Benjamin Junge and Anders Trolle. Anders is at HEC and Benjamin works at a hedge fund in Paris. Anders actually taught all day executive education since 8 o'clock this morning. So he's actually dead, but he still volunteered to participate, and he told me he would jump in and answer any complicated questions. So please ask really complicated questions during the talk. This is a new paper I presented only once before, and we're looking at a new market on credit swap index options. And we're trying to learn something about volatility extracted from these options, and we're particularly interested in how the volatility extracted from these credit options compares to volatility extracted from standard equity options. So what I'd like to do first is give you a little bit of a motivation for this question, and then also an overview of the results. So if some of you want to leave, then after that you'll know everything. You can just take off. And then I'll dive in a bit more in more detail into the model, give you some evidence on this market of CDX options. We have transaction data, which we extracted from data repositories. So we'll give you some sense of how much trading there is and in what type of options. And then we'll focus on quote data, and we'll develop a model and look at this relative pricing of volatility extracted from credit versus volatility extracted from equity options. So I guess it's going a bit quicker than I thought. Here we go. The motivation, as you know, is a traditional view to develop credit models based on structural models, and in this traditional approach to pricing credit, the famous paper by Merton, the idea is that you can think of debt and equity as claims written on the same underlying firm value, and the first applications of these models led to mixed results. The early implementation, tended to find that properly calibrated structural models tended to underpredict credit spreads. This is the famous credit spread puzzle due in particular to Huang and Huang. But subsequent implementations of these models, models that we would call second generation models, that essentially took into account other features of equity models, such as trying to calibrate to equity volatilities, trying to take into account the out of the money put premium that we observe on the pricing of out of the money put option on the index. So these so-called second generation models actually did a lot better at pricing, at fitting the level of credit spreads. And a good example of such models is the recent paper in Journal of Finance by Du, El-Khami, and Erickson. So this has led some to and this is a quote from the recent paper from the AER by Kolb, Nozawa, and Veronesi, to argue that there's a good deal of integration between corporate bond and option markets. Right? In this paper, in fact, they propose, for example, to extract implied volatility from equities and build so-called pseudo firms whose credit spreads, whose implied credit spreads, they find fit quite well with the historical data on actual credit spreads. So based on these sort of more modern or more recent implementations of structural models, the conclusion might be that corporate bonds and equity markets are quite well integrated. However, if you look at evidence from corporate bond returns, or empirical papers that focus on bond return, and historical the cross-section of corporate bond returns, the evidence is more mixed. So in a very old paper, joined with Bob Goldstein and our good old friend Spencer Martin, we had looked at whether you can explain credit spread changes with variables on the equity side that are predicted by structural models such as leverage, volatility, and others. And there we found that actually these variables predicted by structural models did not that good a job. They captured maybe something like 20 to 30% of the variation in credit spreads. And furthermore, we found that there was quite a bit of commonality in the residuals from these regressions. So this type of results have been confirmed with more recent data by a paper by Hiko, Rami, and Song. And these authors, in fact, argue that the commonality in the unexplained movements in these credit spreads seems to be related to intermediary balance sheet factors. There's also, going back to Fama-French and more recent papers by Bay, Bally, and Wen, there's also some papers that try to compare the classic Fama-French equity type factors and see whether these factors, the betas to these factors, price the cross-section of bond returns. And again, there, the evidence is also mixed. It seems to be that one might need bond-specific risk factors to explain the cross-section of bond returns. But others don't 100% agree with these, so there's still some debate about on these questions. Do we need different risk factors to explain the cross-section of corporate bonds versus cross-section of equities? And so, given these two separate views, the second generation model that seemed to fit quite well the level of credit spreads, and then this mixed evidence from looking at factors predicting the cross-section of bond returns, we thought it's quite interesting to look at what option markets tell us about volatilities extracted from equity and bond data. And for that, we're going to focus on this credit spread index options. It's a market that has actually was actually active before the great financial crisis, but didn't take off. There was more trading in tranche markets before the great financial crisis. But since 2012, the volume, as I'm going to show you, has actually increased tremendously, and transactions have increased a lot. This market has become very liquid. So what we do then in the paper is we try to look at the implied volatilities that are coming from both markets, the credit spread options, credit default swap options, and the equity options, and we try to compare them. Now, what's interesting is that the market convention is very different for both these markets. The implied volatilities quoted for credit default swap options actually credit spread implied volatilities based on some reduced form model, whereas, as you all know, the implied volatilities quoted for equity index options, they use a Black-Scholes type model where the underlying quoted implied volatility is that of a stock price. So really, the two implied volatilities that are quoted are not readily comparable. One is a credit spread volatility, the other one is an equity volatility. And furthermore, they're extracted from prices using models that are not consistent with each other. On the credit side, it's the reduced form model that's based on assuming that defaults arrive as jumps. And on the equity side, this is just a Black-Scholes type model. So because we can't readily compare those two volatilities to decide whether they're consistently priced, we actually propose a structural model, which is a classic structural model based on an underlying asset value process for each of the constituent firms of the indices. And based on that structural model, we essentially get consistent prices for both the credit options and the equity options. And we can thus extract implied asset value volatilities to see what is the relative pricing across these two markets. So in a nutshell, the model is one where each firm in the underlying index follows a certain jump diffusion process. Firms will be issuing both short and long-term debt. So we will be able to price the bond or the credit default swap using a put-like formula. The equity will be like a call on this underlying asset value. This is in the spirit of Merton's 74 paper. Then we can price options on the individual equities and options on the credit default swaps as compound options. And then we can aggregate these individual equity prices and the individual CDS prices to get an index. And there we're going to use this idea of Vasicek of using a large homogeneous pool approximation so we can get an explicit solution for the index, both bond, CDS, and equity indices. And then we can use those distributions to price options on the indices. And so everything is obtained in closed form, which then allows us to calibrate the models quite quick. So what we do then is we calibrate the model to parameters that match the level of the equity indices, the level of the credit default swap indices, the whole implied volatility surface on equity options. And then we look at what the model predicts for the credit default swap options out of sample. And what we find is that the jump diffusion model that we proposed does quite a good job at matching the dynamics of both the SPX, so the equity options, and the credit default swaptions. That is, the model does a good job at getting the leverage effects and the skews of both markets correctly. However, the level of the credit volatilities is underpredicted across all strikes by the model. And in fact, then, we find that that the evidence, at first you might thought, well, this is maybe a problem with the model, and we'll try to discuss that. But we also find that consistent with this result, a trading strategy that sells volatility through the credit options generates a much higher Sharpe ratio than a trading strategy that sells volatility via the SPX options. And so, this result that somehow it seems like credit options are priced using a higher implied volatility than the one that would be consistent with the prices we observe on equity options. Right, that seems to be like a sort of a new puzzle to us, and we've sort of thought about what would be potential explanations for this, and we came up with at least 5. So the first is, obviously the model could be misspecified, or we could be missing something significant there. I'll try to discuss and argue that what the type of misspecification we need to explain this result has to be something quite special. It has to be something that drives a wedge between the volatility extracted from equities versus credit. So it has to be something like stochastic bankruptcy cost, if you want, something that really would affect the bond volatility, but not the equity side. Then it could be that the options actually span different states, right? We observe options with different strikes, but one is options on spreads, the other one is options on equities. The strikes are not readily comparable, but if we look at those strikes from a point of view of strikes in terms of the asset value, we actually find that they're quite similar. So these options from an economic perspective seem quite redundant. So then something must give. Why are these options nevertheless perhaps not redundant? And so we find potentially 3 explanations. One is maybe the constituent indices are sufficiently different, even though they're quite large both, and even though they seem very similar in terms of their constituents, maybe there's some heterogeneity there that plays a role. And lastly, it could be that there's different investor clienteles. So, for example, the fact that these options become very liquid after the crisis, one possibility is that they're widely used by banks and institutions to hedge corporate bond indices. And if there is a large demand for hedging corporate bonds portfolios with such options, and if regulators are more likely to accept such options as risk mitigating, then this could potentially drive a wedge between the pricing of these 2 options. And lastly, if indeed there are bond-specific risk factors, that might also play a role in explaining these discrepancies. Okay, so this was sort of a quick overview of the main results for those of you that want to leave early. And now I'm going to sort of jump into the details of the analysis. Obviously, we're late to a very, very large and extensive literature. I've quoted some of these papers already in my introductory slides, so I'm going to sort of jump quickly through that. So we try to discuss them in more detail in the paper. I want to just point out a couple of papers that I think are interesting in their own right. So one is this paper by Bao and Pan that we became aware again recently. And they sort of have very nice analysis where they extract asset volatilities from corporate bonds and compare them to asset volatilities extracted from equities via a structural model. And they also find that realized bond implied volatilities seem to be much higher than equity implied bond volatilities, which seems consistent with some of our findings. The other set of papers that we relate closely to are these papers here on the relative pricing of tranches and equity options, as well as the basket index spread leverage effect. So our model framework is very close and builds a lot on these previous papers, in that we also use a jump diffusion model for asset values. We also use a large homogeneous portfolio approach to model the indices. But in contrast to these papers, we actually introduce also the credit option side, of course, and for that we actually need to introduce a maturity structure of debt. So we have 2 maturities, 2 debt maturities, and we're able nevertheless to derive closed form solutions for the prices, even though these in contrast, these papers relied mostly on numerical analysis. There's also a few papers that actually have looked at this implied credit options volatilities, mostly to build model independent variance swap type volatility indices. And so they're not focusing on the same question of this relative pricing between equity and credit options. But nevertheless, there's interesting papers on this new market as well. So let me now dive into the details of the analysis, and I'll focus first on some transaction data from this credit default swap index option market to give you some sense of the trading. So, small picture here, right? Obviously, credit, bond, equity in the structural model, they're linked because they're both contingent claim on the asset value. The equity options have been studied widely in the literature. These would be options on the equity. So as a result would be compound option on the equity, which is itself an option on the asset value. The missing piece obviously is the bond side. And here, what we're going to use is this new CDX option market as our instrument. I should mention here, and I stress that, right, compared to the perfect picture, this would really fit well into this puzzle if the CDX and the SPX had the exact same underlying portfolio firms. They're not exactly the same, right? This one, the SPX has 500 firms underlying it. The CDX is the broadest default index, investment grade, but it has 125 investment grade names underlying it. So it's not exactly a perfect fit. That's something to bear in mind when we look at the analysis. So the CDX index is the sort of main, most liquid credit default swap index, which allows you to buy protection on a basket of 125 names. The 5-year maturity is the most liquid. Every 6 months, a new index is launched. The new index can be the same if the 125 firms remain in the index. Sometimes a firm may default, in which case it drops out of the basket. Sometimes it may be replaced by a new firm that's more liquid. So every time a new index gets launched, most market participants will roll into this new index to continue to hold the on-the-run most liquid CDX index. So as a result, we will actually focus on this 5-year on-the-run CDX contract. The cash flows, when you want to buy protection on this index of 125 firms, you typically need to pay an upfront to buy protection and an annual coupon that's set to 100 basis points, which is paid on a quarterly basis. If there is a default, you receive as a payment the loss given default on the actual bond that defaults in the sample. So, payments are this upfront and the fixed annual coupon, and what you receive is losses on the bonds within the portfolio. As a result, right, the prices in the market that get quoted are these full upfronts that you need to exchange to enter the contract. Now, it's important to realize that this upfront payment is not really economically very meaningful in itself, because obviously you might have a negative upfront if the actual 100 basis point coupon is already considered sufficiently large a payment, right? So the market price moves that we observe are these upfront prices that are moving, but obviously the true NPV of the total cost of paying insurance is the net present value of the coupons you pay on a running basis and that upfront. And so as a result, the market participants, rather than looking at the upfronts that are quoted on a day-to-day basis, prefer to transform the upfront price that's quoted into what's known as a par spread. And the par spread essentially is going to be the coupon such that the upfront is set to 0. Right? So essentially the standard approach to quoting a CDX index is in terms of a par spread, which you can think of as a standard model implied annual cost of the insurance for that underlying basket. So we can really think of the par spread as a measure of the annual risk neutral expected loss, and it's the annual cost of insuring that basket of 125 names. Okay, now the new contract, one that we're focusing on, is this CDX option. So the option is essentially an option to enter a credit default swap at some future date. So obviously there's there's going to be a payer swaption or receiver swaption, the same way there's a put and a call. For my talk, I'm going to focus mostly on the payer swaption. It's also where the market activity is mostly focused. And to avoid getting confused in my presentation and confusing you, I'm going to focus mostly on the equity side, on the equity put, and on the credit side, on the payer swaption, which is the right to buy protection at some future date. Okay, so to convince you, right, these are the right products to compare, where the payer swaption is the right to buy protection at some future date. So you will agree on the strike, which is this upfront, and at some future date, you will have the right to enter the CDX at some fixed upfront. Obviously, if at that time the upfront in the market is higher, then you will have made money, right? So if you think in terms of the par spread, you're going to agree on a spread, a fixed spread, and if at the time you get to exercise your option, the market spread has increased, that is, the economic situation is worse, then you make money. So the payer swaption is really a call on the spread. And so if you're bearish, then you would buy an out-of-the-money call on the spread, which you would exercise when spread have widened, right? So an out-of-the-money call on the spread is really the appropriate credit option to compare with an out-of-the-money put on the equity. When the equity has dropped, your out-of-the-money put would be in the money, which is precisely when you would expect credit spreads to be very wide and your payer swaption to be exercised. So we're going to focus on this comparison for the analysis. Here's some data on the liquidity and the trading activity in the market. The first column is activity in the underlying, the credit default swap index. The second column is the activity on the CDX options. As you can see, there's a lot more trade in the underlying than in the options. Now, this is an average. On the next slide, I show you the evolution. These trading activity has been growing dramatically in the recent years. Nevertheless, you can see that the average trade size is very big in this market. Here the median trade size is 100. It turns out that the trade size is capped. So this is all based on data we extract from data repository. The trading data repositories, which Benjamin has been an expert at exploiting. So we have data on actual transactions. Unfortunately, a lot of the transaction in these options are not happening on CEF, so we can not actually analyze the actual transaction data for many of these trades. They happen off CEF. They still happen OTC, but there is some fraction of the trades that happen on electronic trading platforms. And for those, we actually have information on the value of the actual trade sizes, the ones that are not reported because only the cap is reported. And so we know that the typical, so you can see that about 66% of the trades are capped. That is that they get reported to the trade repository. Only the max value gets reported, but we can infer the actual trade size, and that trade size is a lot larger. Around 350 million is the actual trade size of these capped trades. So based on recouping data from the actual trades we observe on CEFs and the total data we observe, we can actually infer an actual size of the market, which is a lot larger than the numbers reported here. So the actual number, the number reported based on the caps in the trade size is about $1.4 billion per day, but the actual number is probably closer to 3 to 4 times that, based if you manage to get information on the uncapped trade size. So it's quite a large trade size. You can see that the bulk of the trading happens in 5-year on-the-run series. They're mostly standardized contracts. And you can see that the bulk of the trading is indeed in the payer swaptions, so options on spreads. This is a time series of the activity in this market. So you can see the trend that the market has been growing. You can see the difference between the volume based on the capped information and the actual volume that we infer based on the data points where we do observe the actual non-capped trades. And you can see a very, very a positive trend. And interestingly, you can see the data runs all the way through the COVID-19 crisis. You can see that the COVID-19 crisis saw a lot of activity in this market. And I'm going to show you some interesting pictures on how the volatility behaved around that time. This is how the trades occur across the volatility surface. We have here a different moneyness of the options. The way we define moneyness, M is actually the number of standard errors or standard of volatilities away from the strike, from the forward. So, we have M of 0, that means that the strike will be set at the forward, and M of 1 would be the strike would be set, you know, 1 standard deviation away from the forward. And you can see that most of the activity is around here in this area. That is to say, most of the activity is in fairly short maturity, 1 to 3 months options, and mostly out of the money payer options. This is extracted from some marketing material from JP Morgan. We're not quite sure how accurate this is, but you know, we often get the question, who buys and who sells these things? So you know, with a grain of salt, you can see that a lot of the activity is done by you know, broker dealer and banks. And if in the others here you have insurance companies, then you know, you'd see that a very big amount of activity is due to these market participants. So now we're going to focus on the cross section of the option implied volatilities, and we're going to rely on quote data. We do that so we have a full volatility surface to work with, because when we look at transaction prices, we don't see you know, at a point in time a full picture of that. So this is a nice picture. I thought it was very artistic, so I thought I'd show it to you. But really, the only thing you should extract from that, this picture shows actually the maturities that are quoted. So these sort of lines that are sloping are just saying that when an option starts with half a year to maturity, then you know, 6 months later it has 0 to maturity. So it's just the maturity dimension. And the only thing you should get away from this is that most of the activity happens in the 1, 2, 3 shortest maturity options. And so this is what we're going to focus on. So we're going to focus on comparing CDX and SPX options, 1, 2, and 3 months maturity options. The maturity, the moneyness of the options we define as follows, as I already told you. And we're going to find about 13 different moneyness intervals. To extract the at-the-money options, we're going to regress for every maturity that we have. So we have 3 maturities. For every of the 3 maturities, we're going to run a regression of the implied volatility on moneyness and moneyness squared. So beta 0 is going to be our estimate of the at-the-money implied volatility. Beta 1 is going to be our estimate of the skew, and we're going to focus on those two numbers. This is the first graph of what happened during the COVID-19 crisis. So this is the recent period since January to very recently. And you have here on the left-hand side the credit default swap index level. So that's the annual cost of insuring yourself against defaults in a basket of 125 investment-grade firms. This is the 5-year cost. This is the 1-year cost. Not surprisingly, you see that the cost increased dramatically during the COVID-19 crisis, and then recovered somewhat, but not completely. This is the picture you're probably very familiar with from the S&P with the rebound. And obviously you can see some commonality there, right? As the crisis hit, credit became much more expensive and the S&P dove. Now this is the corresponding picture for volatilities. On the right-hand side, the VIX, which you're also familiar with. You can see this 70% maximum level attained by the VIX. I wish I had sold some there. I'm sure I'm not the only one. You can see commensurate, right? A tremendous increase in the implied credit index volatility, and they sort of peak roughly at the same time. So again, commonality there. And now lastly here, you can see the skewness picture. So you can see that on the S&P, the index became a lot more negatively skewed, as you would expect if out-of-the-money puts become a lot more expensive and the crash probability increases. But what's interesting there is you can start to see a little bit of a different picture on the credit side, right? You can see that at the beginning, the credit spread skewness widened, became more positive. So that's what you would expect, right? If you think about it, because the credit spread, again, on the credit side, we're talking about a credit spread option. Credit spread option, right, will pay off when credit spreads widen tremendously. And so, and if volatility increases in those states, then we would expect a positively skewed credit, implied credit volatility curve. So the same way that as the S&P drops, the skewness on the S&P, the implied volatility, equity volatility becomes more negatively skewed. The same way we would think it's consistent to see an increase in the positive skew on the credit side. But what you can see is that, interestingly, so that is essentially a measure of the sort of credit crash probability, if you want, that becomes more significant. But you can see that it recovers much faster, much earlier than on the equity side. And these bars here that you have on the graph, they correspond to different events. This was the Wuhan lockdown. This was, issues in Italy. The last two bars correspond to when the Fed announced some support for the credit market. Right? As you know, that there was a lot of talk of the Federal Reserve starting to announce that they might buy corporate bonds and in fact buy some corporate ETFs. Right? So you can see that here, this might be a first cue as to why we have two separate markets. There might be slightly different factors affecting these differently. These are some stylized facts from these markets. Lots of pictures. I'm not going to take you through all of those. Let me just focus on a couple. These two pictures here are the ones you're most used to, which is the classic relationship between the so-called leverage effect. The fact that when the S&P 500 drops, then the S&P 500 at the money vol increases. So this is your leverage effect. You can see that you have a similar leverage effect on the credit side, but again with a different slope. As the credit default, as the credit spread widens, then the at the money implied vol from credit, increases. So some symmetry here, and at least empirically, that seem to indicate that these two markets are quite related. And these are some pictures of the stylized facts extracted from these two markets. The fact that we see negatively skewed SPX options and positively skewed credit spread options. So we see lots of commonality in between these two markets, and the question is, well, how well can we capture those with a model where we could actually get readily comparable implied volatilities? And so that's what we tried to do next. So the model we're going to develop is a classic structural model. We assume that every firm in the basket has an asset process that has a common factor, and this common factor has some common diffusion shocks and some common jumps. So this would be your market-wide crash events. And then each asset has some idiosyncratic shocks, both idiosyncratic jumps and idiosyncratic diffusion shocks. We're going to assume that each firm that has this asset value process has both short-term and long-term debt. We're going to try to fit the 1 and 5 year credit spreads. So that's why we have these two maturities. And default occurs optimally at these two dates. So at the final date, default would occur if the asset value is below the promised debt value. And at the intermediate date, there will be an endogenous default threshold, which is the firm would pay the D1 that's due if and only if the continuation value is higher than the payment. We assume some bankruptcy cost alpha, and we assume that recovery, if default were to occur at the intermediate date, T1, the recovery will be as a percentage of the outstanding fraction of face value. So these are all classic assumptions. With these assumptions, we can price debt and equity. So just to take you through one equations, the debt would just be the present value of the payoff paid promised at time 1 if there is no default, that is if the asset value is above the default threshold. And if the asset value is below the default threshold, then you would get a recovery, which is a fraction of the asset value. And long-term debt would be the same thing, it's discounted cash flows. So discounted value of the payment received at the terminal date if there has been no intermediate date default, and at the final date, the asset value is above the promised payment. If at the last date, the asset value is below the promised payment, but there has not been default at the intermediate date, then you get the recovery. And lastly, you get a term, which is the recovery that happens at date T1, if at the intermediate date there had been a previous default, right? And then, of course, the stock price would be priced similarly. All these options can be priced in closed forms. We can now also consider a credit default swap contract, which is essentially the value of buying protection on the 5 year. We're going to focus on the 5 year CDX here. So a CDS contract in this world would pay you in case of default at the intermediate date or at the final date, and what you would receive is the recovery at both these dates. And in return, you would pay a coupon, and you would pay the coupon up until default, which means you have a risky annuity formula. And so then you can extract the upfront payment, which would be the difference between the net present value of the protection payments and the present value of the coupon payments. Okay, so this is all pretty classic. Where things become a bit more complicated is when we look at the index. An index, a credit default swap index, now is going to be a sum of 125 individual credit default swaps. And here we use this nice idea of Vasicek, which is this, in theory, we should stop this sum at n equals 125, but we take the limit when n goes to infinity. And we use this idea of Vasicek that conditional on the common factor, then we can use the law of large number and get an explicit solution for the sum, conditional again on the common factor in terms of a conditional expectation. And so we just get an expression here where you see lots of, conditional expectations, but with these underlying distributional assumptions we made, turns out you can get all these expressions, all these conditional expectations in closed form in terms of sums of univariate and bivariate normal distributions. Similarly, we can get the index in closed form, and then the last step is to price the options on the index. So for example, the credit default swaption will be paying you the upfront that's gonna prevail at maturity, and that's of course only dependent on the common factor in excess of the strike. Okay, and again, it looks complicated, but in the end, it's just about computing conditional expectations. In the interest of time, I'm just going to move forward. We have all the explicit solutions for these options in the paper. So we have then to calibrate this model. We calibrate it to the equity option side, and then we look at the pricing out of sample of the credit options. We make sure that the parameters are such that we fit always perfectly the level of the credit default swap, so the risk-neutral expected loss implied from the CDX index, and we price the SPX level perfectly, and so those are always going to be priced perfectly, and then we choose the parameters. We have a total of 10 free parameters to fit as well as we can the level of the credit of the equity options, and then we look at out of sample at the credit options. So let me first show you a sanity check, which is, if we didn't have to price something out of sample, if we could price both in sample, would we have a chance at pricing the options? You can see that the model does a really good job if we price in sample. So if we price in sample SPX options, we can do a really good job. If we price in sample CDX option, we do a really good job. So at least in principle, the model can do a really good job at pricing the cross-section of credit and equity options. The blue line here shows you that this is not obvious, right? For example, this blue line corresponds to the model where we turn off jumps. And you can see that if we turn off jumps, we have pure diffusion model. Then the model is unable to price either the SPX or the CDX skew. In fact, what's interesting is on the credit side, the pure diffusion model predicts the wrong sign for the skew. And this is actually an analytic result we can prove. So, if on the SPX side, one might think that the skew could be due to the endogenous leverage effect, the actual financial leverage effect, the evidence from the credit options tells you that this is probably not the right explanation. So this is then what we get when we do the out of sample experiment that I mentioned before. So we fit the parameters so that we hit the SPX options as well as we can. So you can see the model does a really good job. And then when you look at out of sample, you find that the predicted levels on the credit side are a lot lower than the actual observed option prices. Even though you can see that the shape of the smile is actually quite good. And so we can confirm that by actually looking at the time series of results. You can see if you look at the time series of result, we have a model that prices the SPX perfectly, prices both the 1-year and 5-year CDX perfectly. That's the model is calibrated to that. It does a really good job at fitting the at-the-money SPX vol. Does a really good job at fitting the skew on the SPX on the equity side. It does a really good job at capturing the skew on the bond side, and does a fairly good job at capturing the time series dynamics of the credit at-the-money implied vol. But there seems to be a level difference. One interesting data point you can see is that this seems to be a discrepancy during the COVID-19 crisis in the estimates of the model implied skew. So again, this is related to the discussion I had before of these events around the Fed announcement of their support to the credit market, where somehow these two markets seem to disconnect each other from each other. You can see that in terms of fitting the time series leverage effects that I mentioned before, actually the model does it also really well. So this is, of course, a recalibrated model to the equity side, but you can see that the dynamics seem to work quite well, right? So you can see that on the credit side, we fit quite well the credit leverage effect, right, in the model. So there just seems to be a distinction in the levels of the predicted vol, but in terms of the dynamics, the model seems to be quite successful. So, what might explain our findings? Obviously, there are lots of reasons. We came up with at least 5. First one is, the model could be misspecified. So even though we have a rich model where we have idiosyncratic diffusion, idiosyncratic jumps, common diffusions, we don't actually have explicitly stochastic volatility, for example. But in our view, adding stochastic volatility will probably not help much, because our model is recalibrated weekly. And what you really need is, you need to find a way to introduce a wedge between the credit implied volatilities and the equity implied volatilities, remembering that both the credit default index and the equity index, they're both options on the same underlying asset value. So something that will make the underlying equity more volatile is highly likely in most structural models to also make the underlying bond index more volatile. So you need something that's able to introduce a wedge between the two. So stochastic bankruptcy cost, for example, might be one idea. There might be other reasons why CDX and SPX are not redundant, right? You might think that the options actually span different economic states, right? It's not clear that the two strike ranges that I've shown you are comparable, because one is a strike in terms of the credit spread, and the other one is a strike range in terms of the stock price. It might be that the two underlying baskets are quite different. Or it might be that these two products have different investor clienteles, or there are different bond market specific risk factors. So let me try to at least give you some idea about the first two. First, on the notion that these two options might span different economic states. One thing we can do with the model is translate the strike range we observe on the credit side and the strike range we observe on the equity side in a strike range in terms of the underlying asset value that's implied from the model. And what you see here on these graphs is exactly that. The implied strike ranges for equity and implied from equity options, and the implied strike ranges implied from credit options, but expressed in terms of asset value. And you can see that in terms of that, these two options seem very similar. And in that sense, this is very different from the literature on the tranches, because when the literature focused on the tranches had two issues. One is that tranches had relatively long maturities, 5-year, compared to the equity options that are typically short maturity options. And the second issue was the super senior tranches typically correspond to strike ranges that are way, way further out of the money than the strikes quoted on S&P 500 options. Here, it seems like both in terms of maturity, they both have maturities of 1 to 3 months, and in terms of the asset value ranges, these products are very similar. So of course, that kind of deepens the puzzle in the sense that these two products seem, from an economic perspective, to have payoffs that are very, very, very similar. So then, maybe the underlying indices have different characteristics. So in the few minutes that I have left, I'm going to go a bit more quickly. I'm going fast already, but you can see here some distribution of the underlying CDX index leverage and the SPX, so the equity index. And here we have sort of the distribution of leverage for these two indices. And here you have the distribution of ratings for these two indices. And so when you look at that, you see, of course, that there's a difference, right? For example, you can see that on the equity index side, there are some firms that have zero leverage. And clearly, you're not going to have those firms in the credit default index. But at the same time, you can see also that you have also much more dispersion. So you also have riskier firm on the right-hand side. Similarly, for the ratings, they actually look quite similar in terms of their median and mean. So if we focus on the median and mean, then these two indexes looks quite similar, but the dispersion seems to be wider for the SPX. So that could be an explanation, potential explanation for our findings, and something that we need to do more work on in terms of the robustness of our finding. One idea that we have is that we're currently looking at comparing this to S&P 100 options to see whether we find the same results comparing credit default implied option volatilities to those of the S&P 100. In terms of the time series, the average leverage look very similar across both baskets. So in terms of the median, mean characteristics and the time series of the mean and the median, they actually look quite comparable. Another possibility is that there's different demands, the different clienteles for these two options, right? There have been a few papers that have pushed that as an idea for the time variation we observe and the size of the skew on the equity side. It's plausible that we have a different clientele, even though these two products might look very similar from an economic perspective. In informal discussions with regulators, I was told that they would never accept an equity put to hedge a bond portfolio because equities and bonds are just not the same assets. At the same time, a credit default swaption is more likely to be accepted as a risk mitigating hedge instrument for a bond portfolio. So we don't have strong evidence in that, but it's certainly a possibility that because of different regulatory treatment, there might be different demands. And that would also line up with the fact that the volume on these options has picked up a lot after the great financial crisis. Consistent with the fact that they don't seem the CDX swaptions seem overpriced, if we just implement a very simple strategy of selling volatility by selling at-the-money straddles and CDX versus SPX, we find that there's a much, much higher Sharpe ratio, statistically significantly higher on selling vol through the CDX than through the SPX. And you can also see that these results hold with and without including the COVID-19 crisis. During the COVID-19 crisis, the Sharpe ratio goes down a little. I mean, it stays still around north of 1, because of course the volatility during that period was much higher. So I had to rush a little bit to the last, but I think I'm out of time. In conclusion, I think I tried to give you some sense of trading in this new credit default swaption market. We try to develop a model that's consistent to price both the credit default swaptions and the SPX options. That was useful because these two markets are quoted in terms of different models and in terms of volatilities of different underlyings. So looking at it through the lens of a structural model is helpful because we can actually get readily comparable implied asset volatilities. The model shows that the skew and the dynamics of the skew seem to be consistent across both markets, but that the level of the credit implied volatilities seem to be higher than the ones implied from the equity side, than the one consistent with those implied from the equity side. And so we're still looking for the explanation for this difference. One possibility that would make these products non-redundant is that there might be different clienteles for these two products, or there might actually be different risk factors. If the evidence that we have from these cross-sectional bond pricing papers is exact, that there are actually some bond-specific risk factors, for example, these intermediary-based factors that would drive the cross-sectional bond returns, or these bond liquidity market factors, then that would justify why we need different products, because they hedge actually different sources of risks if you have exposure to the bonds versus the equity. I'm done. I don't hear you, Mariam. You think you need to
yes, sorry. Thanks so much, Pierre, for the great talk. And now we want to turn to the Q&A. So to start, Patrick Agostin from McGill, can you please ask your question?
Hello, can you hear me?
Yes.
Yep.
All right, so thanks a lot for a great talk. I just had two quick questions. So you started motivating your talk by the question of whether option and credit markets are integrated. And so what you show us is kind of the level difference in the implied vol between the two markets, but the dynamics seem to be consistent with each other. So in terms of the conclusion, is that still kind of, would that say that they are integrated or not? And my second question I had is that in terms of the ISDA model, where you do the mapping between the upfront price and the par spreads, because that requires a choice on the term structure of interest rates, in particular up to like the 5-year protections that you would pay. And I think Anders already answered this, but before in the chat, but in principle, I'm wondering whether kind of that choice of the relevant discount rates, whether that could kind of have any implications for this level difference.
Okay, I mean, thanks for the question. I think in terms of how are these integrated or not, I mean, I think we have to be careful because we haven't exploited all the potential model misspecification, or there might be actually different characteristics of the underlying portfolios. That's something that requires a little bit more work from our perspective. But I like the picture I showed you about what happened during the COVID-19 crisis, and if you look at so it's true that they look fairly integrated, but you can see, for example, right here, right, that the dynamics are not quite the same, right? That there seems to be these episodes, and these episodes might be quite significant for an investor, right? Where somehow the spread implied crash probability looks very different from if you extract that from credit spreads and if you extract it from the equity side. So, right? But again, I think our current favored interpretation is that there might be some extra premium on the credit side because of that extra demand in terms of the hedge that these products give you when you present them to regulators. So I do think that it's difficult for a financial institution to hedge a bond portfolio with an equity option, and it's probably a lot more acceptable to the regulators if they hedge them with a bond option. So that would be, I think, our favorite explanation. But we can't dismiss all the other ones. Regarding the answer, since Anders already answered you, then I will let him answer you if he's happy to step in. I would just say that in general, risk-free rates don't have a very big impact on the pricing of credit default swaps. Let's say if you took a deterministic interest rate model, then it would actually wash out with continuous compounding. So, and then of course, they will have some impact if you look at discretely sampled payment dates. But typically, the interest rate sensitivity or the discount rate sensitivity of the CDS is not very, very large. But Anders had probably a better answer. So, are you still around, Anders, or?
Yeah. So let me just add that when it comes to the CDX option payoff, it's in terms of the upfront values, which are really what is traded in the market. And so I don't think that the conversion from upfront to spreads are important in our case. It's important when we actually represent the option prices in terms of spread implied volatilities, but in terms of the option prices themselves, I don't think it's particularly important. Of course, there's then one question like, what discount rate should we use to discount the option cash flows? But there we use the same discount rate on both the SPX option side and the CDX option side. So I think it's highly unlikely that would affect the relative valuation of the options.
Thanks a lot.
Okay, so the next question is from Bjorn Ereker from Wisconsin-Madison. He seems not to have, his mic seems not to be working. And correct me, Bjorn, if I'm wrong.
I think it just came on.
Oh, excellent. So can you please ask your question?
Yeah, I was just gonna, I just had a comment. I realized that your model doesn't contain any stochastic volatility or any other state variables that will drive the relative prices or the implied volatilities of these things. So your model is sort of comparable to a Black-Scholes style model, just with all the added layers of the structural structure of the corporations. But if you added stochastic volatility or time varying jump intensity or any one of those things might look different, right?
Yeah, so indeed, it's something we need to do. The one comment we made, right? So when we show you these pictures and we say, the model does a good job at fitting the time series relation, here we're recalibrating the model every week, and so this impression you get that the model does a good job at fitting the time series, right, is a little bit misleading in the sense that we're calibrating the model, but at the same time, it tells you that probably adding stochastic volatility right, will give you a model that is able to match the time series dimension. Now, you know, the question I think is, would adding stochastic volatility help with explaining the difference in the level of the volatilities, right, and that we get across these two markets? And I've lost it, my picture, right? So would adding stochastic volatility help in explaining that difference? And there, you know, we're a little more suspicious. We actually don't, you know, our hunch right now, we haven't done it, but our hunch is that it's not going to help that much, because you add stochastic volatility at the level of the underlying asset value process, and then based on that you will price the equity as an option on the underlying asset value and the put, and both the equity and the put will inherit the stochastic volatility. And you know, it's very hard for us to think of how adding stochastic volatility at the asset value level could make the out of the money put option on the equity more expensive without also making the out of the money call option on the credit spread more expensive. Anything that in the model will tend to lead the equity right to drop through something you introduce in the asset value will tend to also make the credit spread higher in those bad states. So what you need is some stochastic feature that will drive a wedge between the compound option call and the compound option on the put. And so that's why, you know, something that would have a flavor that could work is something like stochastic bankruptcy cost, because of course the bankruptcy cost, they enter the payoff of the put of the debt, but they don't affect the equity, right? So if you have variation in the bankruptcy costs, right, that would enter the variability of credit spreads without necessarily affecting the variability of the equity. So that would be the type of dynamics you need to add, we think.
So I'm not sure. The thing is, the way I think about this, if you look at CDX, they appear to be very highly correlated with VIX.
Yeah.
And as such, the options on the CDX appear kind of more similar to options on VIX than options on equity, to me. And for that reason, that, you know, you can think about comparing the risk premium or the implied volatilities on CDX to the VIX derivatives. It is not exactly that, because, you know, like CDX is going to be some sort of combination of equity price and VIX, maybe, in a more general model.
It's true what you say. It's true that VIX and the CDX are highly correlated, but it's also true that that VIX and SPX have an extremely high negative correlation, right? So if you look at these are just the data points are just data, right? They're not model dependent, right? And you can see, for example, a very tight relationship here between SPX and VIX, right? As you know, and you're an expert in this. But you can see this relationship is a lot less tight when you look at CDX and its implied vol. So there seems to be. It could also be that this market is newer and it takes some time for, you know, the market participants to adjust in how to price these things. But there seems to be, you know, more vol on the CDX side than on the SPX side. But, you know, I think it's something we are planning to do, to actually add stochastic volatility and see whether we can, with that, help explain our findings. We really doubt it based on our intuition, but intuition is often wrong. So we're going to try to do it, but it's actually hard, because then you have to price compound options with stochastic volatility, and then options on compound options with stochastic volatility, and that is not easy to do in any explicit form. At least we haven't found yet a very simple way to do it. So I think we'll have to do lots of numerics to get there.
Okay, perfect. Thanks, Bjorn, and thanks, Pierre. So the next question is from Mirela Sandulescu from Michigan.
Hi, hello. Can you hear me?
Yes. Hi, Mirela.
Hi. So great talk. I have a couple of questions actually, like whether you have a formal definition of market integration, because in the end, sufficient condition.
I thought that's what you work on.
Yes.
I thought you could tell us.
Yeah, so in the end, the sufficient condition would be that you have an agent that is able to trade both stock options and bond options, and then this would be sufficient for the markets to be integrated. Then another question was whether, yes, you have thought about how to deal with this joint hypothesis problem of correct model specification and market integration, and whether this is actually mispricing or just model misspecification, and if it's mispricing, if we know that it can be statistically significant, but from an economic point of view, whether is it also significant? So have you tried, for example, comparing it with some measures of trading costs or bid-ask spreads?
All good questions. I mean, so I think on your first point, do I have a definition of market integration and whether one agent that can trade across both our markets is sufficient? I think one agent trading across both markets is probably not sufficient, right, for both markets to be integrated unless this agent has very, very deep pockets. But I think in your research, right, you're looking for a common pricing kernel, right? That's what you're doing. I think that's probably right. That's probably a good good starting point. Right here, right, based on the model, we extract the same. We have a common model that should price both in a consistent fashion, and then know that the model is correct, and then we extract a vol from one and a vol from the other market, and they're not consistent. So here, if the model is right, then we have, I think, a measure of the fact that these two markets are not integrated. Then you can say, okay, this model misspecification. I tried to discuss various possibilities, and again, at present time, give our feeling that that it's not going to be that easy to extend the model in a simple way to fit the stylized fact we find, except for adding something like stochastic bankruptcy costs. The only thing I can say about whether the only thing I can say is related to the, I don't know if you can still see my slides here, but it's related to the empirical experiment we do, right? Where at least that experiment seems to suggest that the Sharpe ratio you can attain by selling vol in one market is a lot higher than in the other. And so, if you ask whether this is statistically significant, the difference between those two Sharpe ratios is very, very economically significant for sure, right? If you have Sharpe ratios around 1 or 2 and 0.4 in the other market, that's a big difference. Now, admittedly, this is not an extremely long time series, 8 years of data to get reliable estimates of means, and this is a market that's emerging. So it's often the case that in the first couple of years, the prices may be a little bit off, so we have to be careful. So I think more work is needed here. I forget your next question. Anders, do you have anything, you want to add anything or remember?
I think I don't have much to add. I think so. Your other question was about the joint hypothesis problem, and I mean, it's we of course in the end we cannot definitely say that the market is mispriced and our model is the correct model. But we have at least some suggestive evidence that the two markets are not fully integrated.
I mean, you asked about transaction costs. I think that's the one I forgot. Yeah, you asked about transaction costs. So we have not added actually transaction costs here, but and it's true that in this experiment here we're trading weekly, so for sure transaction costs would probably have an impact on your performance. In a different experiment that we don't report in the paper currently, we actually bought the shortest maturity options. I mean, of course, on paper, but then held them to maturity. And so there the transaction cost would be minimal. I mean, you just buy them at at the beginning of the month, you hold them for 1 month, and then let them expire. And even there, we found very high, substantial Sharpe ratio differences, and they were high on the CDX side.
Thank you.
Okay, perfect. So the next question is Neil Stoughton from ASU. Neil, can you please ask your question?
Hi, Pierre. I'm actually in
Hi, Neil.
Nice talk. Found it very interesting. Just wanted to point out, I was actually taking a look because I was teaching a class on, and I looked at the bankruptcy filings of Hertz, and I noticed a very complicated capital structure there. A lot of ABS, securities, financed by the leasing and all that sort of thing. And then they also have some corporate bonds. So, the actual capital structures of some of these companies are going to consist of things other than what you would see in the CDS market. So when you are looking at equities, you're looking at everything below a whole bunch of complicated debt securities, only some of which are involved in the CDS and in the CDX index. So I was just wondering whether that is a potential explanation for some of the differences.
Tough question, Neil. I don't know is the answer. In what sense? So you're saying that, okay, so it's true that the capital structure that we modeled here for our typical firm in the index is very, very simple. Is that what you're saying? So
yeah.
and so
and both I guess the 1 year or whatever and the 5 year is all the debt that's in the capital structure of the firm in question, right?
Yeah. So we just said, okay, we need two maturities, short term and long term, because we want to hit the 1 and the 5 year spreads, and so we need a possibility of an early default, and then we match we look at the balance sheet of these firms and we sum up all the short term debt under 1 year, and then we look at all the long term debt and we try to match the short and long term leverage of these firms, and we take the average across the whole basket. So I have to admit, right, obviously, that this is a very simplified structure. It's not clear to me how. Maybe having more heterogeneity, right? Right now we're assuming all firms are homogeneous in that form, and we just match the average 1 year across all those firms in the basket, and the average 5 year across all the firms in the basket. So maybe assuming that there's a lot more heterogeneity in the debt structures, this could be an explanation.
Well, I guess one thing that strikes me is it could be a little bit related to the idea of the stochastic alpha or whatever you were just talking about, in that what's left in some sense for the debt holders could be highly contingent on this more complicated nature of the capital structure situation I'm talking about.
It's possible. I just don't know.
Okay, well, I don't have the answer either. Thanks.
Okay. Sorry if you
Thank you,
guys
Neil.
are done. So the next question is Snag Byung-So from Wisconsin-Madison. Snag, please ask your question.
Hi. My original question was whether you consider front-end protection when pricing CDX options in your model, because missing this unique feature might result in a meaningful gap in prices, especially when the likelihood of default is high. But Anders already answered this question sort of over chat, so I wanted to ask you a different question. Your paper basically examines the consistency between the equity and CDX options market, which is really important and interesting. But what about the consistency between CDX options and CDX tranches? So I'm a little bit curious if you check this, because your JF paper with Bob basically says that the equity option market and CDX tranche market are consistent through a lens of a structural model. So is that the case between the CDX options and CDX tranche market? And that might be a simple sanity check to make sure that your model can price all CDX products in a consistent way before we move on to the equity market.
That's good. It's a good question. Let me first rephrase what I think we showed in our JF paper, because I have a slightly different interpretation. I think what we showed in the JF is that actually the equity options and the tranches, they span very different economic states, so that actually you cannot really extract the state prices from the equity options and price model independently all the tranches. Turns out the super senior tranches and the senior tranches, they correspond to strikes that are so far out of the money that you cannot actually get the state prices reliably from the right. It requires extrapolation. And so one of the points we made is that you can easily add an additional, we called it super catastrophic jump, which essentially will not change anything to the shape of the skew that you fit on the equity side, but will have tremendous impact on the relative pricing of the super senior versus the equity tranches. And so in that respect, yes, they can be consistently priced, but actually they span different states. And then the other problem in the tranche market is that the tranches typically have 5-year maturities, whereas the SPX options, they have 1 to 3 months maturities. And so for the JF paper, we actually relied on some proprietary data we got on long-dated OTC equity options. But again, there, how reliable is that data? I don't know. So it's not as highly liquid and as highly traded as the SPX. So you cannot really directly infer. So you need these long-dated options to be able to say something about tranches. And even then, you cannot price the super senior because they span different states. So here, the nice thing about the setup, which we thought was nice, is that actually they have the same maturities, the options, 1 to 3 months. And when we look at the strike ranges that they span the exact same strike ranges. So there's no need to extrapolate. And so based on that, I think we would feel more confident or comfortable in talking about relative pricing between these two instruments.
Okay, thank you.
Maybe one thing to add is that during this time that we're looking at, meaning from 2012 until today, the tranche market has become very illiquid. I mean, the CDX options market is many times more liquid than the tranche market. I'm not sure how reliable the quotes that we could get from the CDX tranche markets are.
Okay.
That's a good point.
Thanks so much. Thanks a lot, Pierre, for the talk. All the audience joining us not only today, but throughout the whole finance workshop. And we look to see you all back for our session, which starts after the NDR, Friday, June 24th at the same time. Thank you, guys.
Thank you, Mariam. Thanks a lot. Thank you all.